Congratulations, you have finally sold your business, the one you built from scratch, worked endless nights for, and sacrificed weekends over. Now you have got money in the bank and maybe even a little champagne on ice. But before you celebrate too hard, there is one guest you cannot forget to invite: the IRS. Hi, I'm Aradhna Agarwal. I am a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. And today I'm walking you through what really happens, the tax consequences of selling your business. So you know exactly what you keep, what you owe, and how to keep Uncle Sam from being your biggest shareholder. When you sell a business, the IRS doesn't see one big sale. It sees a bunch of different assets being sold individually. You might see a single price tag, but tax law does not. It divides the deal into parts: equipment, furniture, and inventory, customer lists and goodwill, real estate or property, and maybe even intangible assets like trademarks or brand value. Each of these has different tax rules. Some might be taxed as ordinary income, others as long-term capital gain. Example: if you sold your business for $1 million, the tax treatment might break down into $100,000 for equipment, ordinary income; 700,000 goodwill, capital gain; 200,000 inventory, ordinary income again. And trust me, how that breakdown is negotiated can make a massive difference in how much tax you actually pay. This is one of the first and most important questions to answer. Are you selling the assets or the stock, the ownership interests of your business? Let's break it down. Number one, asset sale, most common for small businesses. You are selling the individual pieces: equipment, inventory, customer list, goodwill. Buyers love it because they get a stepped up basis, meaning they can depreciate assets anew and save on future taxes. Sellers often pay more taxes because some of these gains are taxed as ordinary income instead of lower capital gains. Stock sale or membership interest sale. You're selling the ownership itself, the company's shares or LLC's interest. Sellers love it because the gain usually qualifies for long-term capital gains and it lowers your tax rates. Buyers hate it because they inherit your company's old tax baggage, depreciated assets, potential liabilities, and all. Sometimes deal structure is negotiable. You might accept a slightly lower price if it saves a significant tax or vice versa. That is why having a CPA at the negotiation table pays for itself fast. Not all gains are created equal. If you have held your business or business assets for more than a year, your gain likely qualifies as long-term capital gain, taxed at lower rates, generally between 0% to 20%, depending on your income. But if some of those assets were held for less than a year, they get hit with ordinary income tax rates, which can be significantly higher. Even worse, certain portions like recapture, depreciation on equipment, or real estate are always taxed as ordinary income. So your timeline really matters here. If you are even thinking about selling, you might save thousands just by waiting to cross that 12-month mark. One of the trickiest and most powerful pieces in a business sale is something invisible: goodwill. Goodwill represents the value of your reputation, brand recognition, customer relationships, and all the things that make your business desirable beyond the tangible stuff. For you, as the seller, goodwill generally qualifies for long-term capital gain treatment, which often means paying lower taxes. But be careful. Incorporated businesses might have personal goodwill from you individually and corporate goodwill inside the company. Allocating personal property between the two can hugely affect your taxes. Have your tax advisor help document how goodwill was built, who owns it, and how it is valued. It's one of the most misunderstood and misreported areas of business sales. If you're selling your business and it's not an all cash deal, good news. The IRS allows you to spread your tax bill over time through something called the installment sale method. Here is how it works. Rather than paying taxes on the full sale this year, you recognize income as you collect payments from the buyer. This helps you spread the income over several years, potentially stay in lower tax brackets, optimize cash flow for future planning. But heads up, this only applies to sales of capital assets, not inventory or items where income is immediately recognized. It is a great tool, but it needs to be structured properly before the sale closes, not after. Two things business owners often overlook. Number one is depreciation recapture. Those tax deductions you took over the years for equipment or property depreciation. When you sell those assets, the IRS recaptures the depreciation, meaning you pay ordinary income tax on it. It's like giving back some of the benefit you took when the assets were used. It stinks, but it's better to plan ahead for it. Number two, state taxes. Each state has its own rules. Even if your buyer is in another state, you might owe state income tax on the sale based on where the business operated. And a few states even tax goodwill differently. That's why reviewing your deal with a local CPA is crucial before you sign anything. Smart sellers don't just sell, they plan. Here are a few strategies that can make a difference. Plan 1 to 2 years ahead. You may shift assets from ordinary to capital gains category with time. Use retirement plans. Contribute before the sale to reduce taxable income. Consider an installment sale or structured note. Consult your CPA before negotiating sales price allocation, not after. The earlier you plan, the more levers you have to pull. The tax savings can easily reach six figures for mid-sized deals. After years of building your company, the last thing you want is to give a huge portion of your hard-earned sale to taxes simply because of poor planning.